Hello and welcome to On the Record with me, Shireen Bhan. Joining me today is a man who is spearheading India's largest airline, Indigo. Peter, many thanks for joining us here on CNBC TV 18. Appreciate your time. For the benefit of our viewers, it has been a beat on all fronts as far as your last quarter numbers were concerned. Revenue up 61%, margins at 22.8% versus 21.5%. Profit after tax at 1,422 crore rupees versus 129.7 crores. All-time high yields coming in for Q3. Peter, the question though is, given where demand stands at this point in time, is this kind of performance sustainable?
Well, thank you. Indeed, the third quarter have been a wonderful and good quarter for us, which was actually, to be fair, long awaited for. After all the difficult quarters we had throughout COVID and even the first quarters recovering from COVID, we have set in motion a wide range of actions and initiatives, and these have coincided with a very strong market situation actually. And that combination of a strong market situation, initiatives on our side, has led to these very strong Q3 results. A little bit on the outlook, we see that still the market it's a strong market and the demand is still strong going forward.
Okay, so you're saying strong market, strong demand. Will you be able to hold yields and deliver and replicate the kind of success that you saw as far as Q3 is concerned? And more importantly, your guidance of being operationally profitable for FY23, excluding forex losses, do you hold that guidance?
Well, there's always some seasonality, of course, in every quarter, and obviously Q3 is a very strong quarter. But with the solid demand we're seeking, made us to be confident looking to the future. I'm not giving any precise numbers in terms of outlook or in terms of precise margins going forward. But again, the range of initiatives we're taking, the solid market demand, the upbeat economic situation in India, all these factors make us very confident in looking forward and basically providing a capacity guidance which we set initially for the entire full year 23 in the range of 13 to 17%. We will be ending up at the very high end of that, more like 17 to 18%, basically underlining that solid demand and confidence we have in the market.
Okay, so that's interesting. You're saying that you will be able to get to the higher end of that band that you had guided for as far as capacity addition is concerned, perhaps even better it, because the band was 13 to 17%. You're saying you could perhaps even do 18%, Peter?
Well, we're aiming for being on the high end, and of course we're not at the end of the quarter yet, but the demand is solid, the situation in the market is good. We've taken various initiatives to deal with the supply chain challenges, and with that we expect to end up at that high range of that margin at 13 to 17%.
So let's understand the initiatives that you have taken. One, to address the supply side issues. B, to take on competitive pressure, which is starting to build now. I'll get to the Air India order in just a second. But both on addressing the supply side issues, what can we expect beyond the measures already taken?
Well, we have indeed the supply chain challenges, which is a global challenge indeed. We have taken various measures to address that. One was to extend some of the existing leases and keep some of the fleet in the operation, which we were initially supposed to return. We have introduced a wet lease operation in order to deal with that. Again, all temporary measures to deal with the global supply chain challenges against the backdrop of a very solid and strong demand here. When it comes to dealing with competitive challenges, we have taken the initiatives, in fact, to reinforce the strong points which have made Indigo into a wonderful company, what it has been doing for the past 16 years. So we have reinforced our customer promise, on-time performance being one of them. And I'm very proud actually on the teams that were back in November and December when it comes to the #1 on-time performance. In addition to those customer promises, on-time performance, hassle-free and courteous service, and affordable fares, we have further stepped up our efforts with further internationalization of our network. We've expanded our international operations hand in hand with some of the domestic expansions and some of the collaborations we have with other carriers in terms of codeshare. So that combination of having supply of capacity on the one hand side, and a range of initiatives when it comes to our customer promise, our international positioning. The combination of these factors have really helped us, and at the end of the day, numbers speak, and I'm very glad with the introduction you gave at the start of this interview with our third quarter earnings and revenue numbers, which indeed were the highest in the history of the company, and basically also on the profitability side. After all these difficult quarters with COVID, clearly Indigo is back in business.
Back in business. Let's focus on the international plans, because you spoke about how that is going to be a key growth driver as far as the airline is concerned. International operations are expected to grow faster. That is what you've guided for. You've also said that you expect the international operations to contribute nearly 23% of your asks as and you've guided for about 30% in FY24. Now, what should we expect in terms of additions as far as destinations are concerned, inking more code share agreements with airlines, etc.? How do you really see your international plans building on where you are today?
Well, Indigo started 16 years ago as a domestic carrier. We've had a wonderful journey over these years, and today we do operate a total of 76 domestic destinations, supplemented by 26 international. So if you look to today's composition in terms of destination mix, it's about 25% is on the international side, and there's 75% on the domestic side. When it comes to our total production numbers, it's even slightly less. It's more in the range of 20-ish% we do international. With the growth of India, with the economic development of India, with the position India is taking more and more on the global stage, and with foreign investments coming in and Indian manufacturers making products here and exporting them, we do see clearly an international growth which is stepping up. And in addition to that, the share of Indian carriers in the international traffic, we believe still has a lot of room to improve and to increase that share. Looking at the position of Indigo for that, these 26 destinations will grow going forward. We've added a couple of destinations in the year 22. We're eyeing now for the year 23 to open up destinations such as Nairobi, Jakarta, and we're reviewing some Central Asia locations. Again, there, the geographical position of India is really helpful for us to develop that network. So hand in hand with the growth of India, the economic growth, the international trade numbers, we're expanding our network with a combination of new destinations and actually increased flight numbers to these international places. And with that, that number will move up from today's 20-ish%, more in the direction of 30%.
More in the direction of 30%. But just for 2023, you gave me a list of the destinations that you are looking at adding on. How many do you expect to add on in 2023 itself in terms of international destinations? And what is going to be the flight frequency as well?
Well, in terms of, again, today, 76 domestic and 26 international, I do expect that for the calendar year 23 or fiscal year 24, we would expect to have anywhere between 10 and 15 new destinations to be opened in a mixture of domestic and international. The ones we have announced already domestic are Dharamshala and Nasik, and international, as I mentioned earlier, we do eye Nairobi and Jakarta as ones. We're looking at Central Asia, and depending on the speed of further opening of China, we'll further open up China as well. So I do expect that this 10 to 15 new destinations would be roughly split 50-50 between domestic and international. For us, it's very important to continue to build on the strength of what has made Indigo to what it is, with an unparalleled domestic network with all these destinations. And not only destinations, really, it's also a set of 400 different routes we fly direct in the country. And that in itself, I think it's a great asset for all the Indian travelers who can now fly direct from one point to the other within the country itself.
Well, you talked about your domestic strength and your domestic advantage, and that is the reason why you enjoy the kind of market share that you do at almost 55%. But let's now talk about the competitive landscape. You've got a Surgent, Air India. You've of course got Vistara as well, and of course the two are likely to be merged by, the target of course is March of next year. You've then got Akasa, and we don't know whether Jet will eventually fly in 2023 or not, but there is a possibility of that. How are you addressing the competitive landscape, and what do you make of the two orders placed by Air India and what it would mean as far as your own fleet addition is concerned?
Yeah, well, that's a couple of questions you combine in one. Let me try to address all of them. Speaking about the order itself, I think it speaks to the confidence and the belief in the growth of India as an upcoming aviation giant. Today, India, I would say, is underserved when it comes to aviation itself, and the growth we're facing actually today and the expectations going forward basically are a proof of the belief in the further growth of that of the Indian market. The order which is being placed is obviously long awaited for, and a lot have been speculated about. And if you were to take the top 10 airline orders in the world today, 2 out of these 10, and probably 2 out of 5, are in fact by Indian carriers. One of them is Indigo. We do have a little short of 500 aircraft on order based on existing orders, and now there's the Air India one. So that basically speaks to the potential and the size of the market in India. And as such, Indigo, we draft our own course, we draft our own plan. So the order itself, it is there. I think for Indigo, we placed our order for growth already in 2019. We do have actually a steady flow of deliveries already now and in the years to come. And obviously for us, we continue to build on that order book we're having. The overall market itself and the size of the market and where the market will be in a few years from now, obviously will have enough room for multiple carriers operating in that market. And if you look from an international perspective, markets the size of India, whether you look at the US or China or the European landscape, they all have multiple airlines or multiple airline groups in different segments of the market. And it's my take that also India will move in that direction.
I just want to pick up on the order book. Yes, you have placed an order of 500 aircraft, but you also did acknowledge the supply chain constraints that not just you, but the global aviation industry is faced with. So what can we realistically expect in terms of annual deliveries? What are you hoping for in terms of deliveries in 2023 to start with? You also spoke about some of the temporary measures like the wet leases, etc. Again, on that front, what can we expect in terms of fleet addition for the calendar year?
Well, we are still assuming a steady influx of aircraft. And if you look just to the number of aircraft we're having and the actual size of it, we're in discussions, of course, with suppliers, what's going to be the precise moment of deliveries and so on. Yet we still do expect a 40+ set of deliveries for the year 23 to come, and we've given some capacity guidance last week, which is in the high mid-teens when it comes to our growth projections for the year 24. When it comes to dealing with the supply chain, I think we're in a good position as Indigo, that we do have a couple of leases where we do have flexibility for lease extensions in order to deal with the supply chain issues, as it's our objective to accommodate the strong demand we see in the market.